The 7 Habits of Highly Effective Investors. These are the basics of running your financial life. That saying about change being the only constant in life never felt truer than during pandemic times. Just as we changed our behavior to help guard against the spread of COVID-19, we can take steps to protect our financial lives from future turmoil. The biggest payoff from shoring up your finances can be peace of mind, but the benefits of preparation turn tangible fast if you face a crisis, without needing to borrow at a high interest rate or sell investments at a loss. So here are 7 ways to improve your financial standing. 1. Save early and automatically. If you have a 401k retirement savings plan at work, you may already save automatically. A majority of large companies automatically enroll employees in retirement savings plans, rather than waiting for employees to opt into plans. Many companies start the percentage of salary a worker contributes, pre-tax, at 3%. That's too low, but saving anything is a great start. More companies also automatically increase how much of their employees' paychecks are saved every year, unless the workers opt out. Ideally, with every direct deposited paycheck, have a set amount go directly into a savings or investment account. You may find you don't miss what you don't see in your checking account. If you get a raise or a bonus, give your savings a raise too. Saving in a taxable account, like a bank savings account or a brokerage account, is important as well. The point is just to program the habit of saving into your life. Watching your money grow can be very motivating. 2. Expect financial emergencies. About 30% of American adults said they wouldn't have cash to cover an unexpected $400 expense as of July 2020, according to a Federal Reserve survey of the financial well-being of U.S. households. That's better than the 36% who said that in April 2020, thanks to government pandemic relief programs and measures. So, start by building an emergency cash reserve before funding a retirement account. You don't want to have to take on high-rate credit card debt. You can use money from your IRAs and 401ks, but tapping them before age 59.5 usually brings a 10% penalty and the need to pay income tax on any early withdrawal amount. That's less of an issue if you save in a Roth IRA, which you put money into after paying taxes on the income. Or sacrifice and build up both pots of money. You really need to get a roommate and eat ramen for 2 to 3 years so that you can do both. It is so important. Many financial advisors recommend building a stash that will see you through 6 months of expenses, especially if your income comes from just one source. The older you are and the higher your salary, the bigger your emergency fund should be, since it may take longer to find a job you want if you get laid off. Be sure to factor in the higher costs that may come when your health insurance is no longer partially subsidized by an employer. 3. Set an asset allocation and diversify. Asset allocation. How to split your money between large cap and smaller cap US and foreign stocks, fixed income investments and cash, for starters, is an investor's most important decision. Research has shown that the vast majority of returns over time come from asset allocation rather than picking the right stock or the right time to invest in the market. You may already have an appropriate allocation if you own a target date fund. These change the mix of assets based on the year you plan to retire and rebalance them to a lower risk profile as you get closer to that date. A classic rule of thumb is to subtract your age from 100, and the answer is how much you should have in stocks. If you were 30, you'd have 70% in stocks, for example. With people living longer, though, there's a fear that without getting the historically higher returns from stocks on a larger chunk of a portfolio for longer, people might run out of money late in life. Whether the classic 60% stock and 40% bond portfolio mix makes sense anymore has been a big debate over the past year. Instead of bonds acting as a hedge to more volatile stocks, both asset classes fell, and the strategy suffered its worst annual loss since 2008, down 17%. But last year's sell-off in bonds was so intense that many analysts expect the fixed income side of a 60/40ths portfolio to outperform in 2023. The 60/40ths mix is having its best start to the year since 1987, returning 4% as of May 2023. What can you do? Geographic diversification, going into other countries, is one of the most important levers investors can pull. While diversifying outside of U.S. stocks can be smart, it is far riskier than investing in U.S. government-backed bonds. 4. Keep fees low. With many people expecting future stock market returns to be muted, it will be more important than ever to keep an eye on the fees charged for your various accounts and investments. Fees have come down for many investment products in recent years, particularly in index funds and exchange-traded funds, but one area where investors may forget to keep an eye on fees is in their workplace retirement savings plans. Plans usually offer both actively managed and passive funds, and the expense ratios on passive index funds are usually much lower than those on actively managed portfolios focused on the same style of investing. For most people, keeping investments simple, in passive, low-cost index funds, is the most cost-effective strategy. Berkshire Hathaway's Warren Buffett is a longtime fan of that approach, and in his 2013 Berkshire Hathaway shareholder letter, and again, at the 2021 Berkshire Hathaway annual meeting, he shared the advice he gave to the trustee of his estate about how the money he leaves to his wife should be managed. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions or individuals, who employ high-fee managers. The expense ratio on the Vanguard 500 Index Fund Admiral shares, VFIAX, which has a minimum of $3,000, is 0.04% of assets invested. The Vanguard S&P 500 ETF, VU, has an expense ratio of 0.03%, and the cost of one share, as of September 19, was about $359. 5. Use an advisor who is a fiduciary. Financial analyst is just a fancy term that doesn't actually mean anything. Even many well-credentialed financial advisors are paid on commission, so if they recommend something for you, it may be because they stand to make money. Sometimes they're actively incentivized not to act in your best interests. If you have an advisor, ask if they are a fiduciary. If they say no, then run as fast as you can. That's a little harsh, but it's wise to stay alert to potential conflicts of interest. There are a number of national networks where you can search for fee-only financial planners who are fiduciaries. They include the Financial Planning Association, the Garrett Planning Network, the National Association of Personal Financial Advisors and the XY Planning Network. 6. Spend less than you earn. Part of what can make it tough to build an emergency fund is lifestyle creep. As we, hopefully, earn more, we often ratchet up spending without thinking about it. We upgrade phones or cars and take nicer vacations rather than increasing our 401k or IRA contributions. Financial planners say most people who are just over 50 and struggling to get to retirement are in such a bind in part because they let spending rise with their income. They had great careers, but never really got ahead in their saving, so they always felt like they were just getting by. Saving a lot for retirement can be near impossible with a family to support, of course. We suggested for parents whose children have moved out should use the cash flow they had been spending on tuition and other expenses into their retirement accounts to try and catch up. 7. Know your risk tolerance. Think back to specific times when you've been stressed out when the stock market plunged, or Bitcoin prices melted down. What did you do? Did your response turn out to be smart, or did you regret it? Investors often overestimate their ability to ride out volatility. You don't know your risk tolerance until you've been tested. The most difficult times could come after a long bull market, when investors haven't recently experienced losses. Young investors, with many years of earning and saving ahead of them, should want markets to turn south from time to time so they can buy stocks cheap. On the other hand, for an older person with no savings stream left, no human capital, stocks are extremely toxic. You get a bad market early in retirement, and your goose is cooked. Be sure to have enough cash on hand to allow you to ride out a down market so you aren't forced to sell. Thank you so much for watching this video, and we thank you again for being a part of our community channel. We appreciate your continued support and look forward to serving you with more exciting videos in the future. We hope it has been helpful in understanding the world of passive income and affiliate marketing. I have my affiliate marketing links listed below on this channel. Please click on them now and discover the best affiliate marketing program I am very proud to be a part of, which is onlinebusiness.app. Don't forget to hit that subscribe button, like and comment below, and turn on your notifications so you never miss a video from Passive Income Journey 777.